Hey there, it's Mitch, Rally Mode. Holy cow, we are getting the show started. It's well after 5 o'clock. It's like a 4:30 show, but hopefully this means I get to bring in more viewers by doing the show at a different time. So I'm Mitch Goldberg. If you haven't seen this yet, what I'm doing now, this is my live stream. I broadcast to Facebook, LinkedIn, YouTube, Twitter. Have highlights all the time on those platforms from the shows, and I also have highlights on Instagram as well. So I usually do the show at 4:30. It's about personal finance, investing, the stock market, the economy, politics, how everything works together. And sometimes you will come to a conclusion based on what I teach you, what you learn here, um, that your best strategy is to do nothing, right? And sometimes you'll come to the conclusion that you need to make a change with your money, with your investments, with how you manage your personal finance. Okay. And these are the kinds of things we talk about. It's about financial empowerment. And I'm really serious about this. And I'm serious about it because I do the show as much for me as for you. I mean, the more I do the show, the better I get with my own money, with my own decisions, with my own investments, what I want to do with my life. And it's really important. And I there's some things I like to feel good about. I like to feel good about my fitness. I like to feel good about my money. Not necessarily just having money makes me feel good. I'm not like Mr. Krabs from the Krusty Krab or something. All I care about is money. Okay, it's an overall lifestyle choice where my attention goes to the things I enjoy when my needs are covered, and I prioritize spending things like that. So it's just something for me. I'm not saying I don't have a good time. I love to splurge on a couple of drinks. We go out, we have fun. I like to do fun things too. But it's that's what the show's about. I'm going on a little bit anyway. So this is an unusual time for me to do the show, but it's summer. It's almost August, and I've been doing the show for like holy cow. October will be 3 years. So once in a while, you mix it up a little bit, and sometimes you take breaks. Instead of taking a break and forcing myself to do this at 4:30, I had some things to take care of, some people to speak with that had to be taken care of. So hence, we're doing this a little bit later today, and I think it's important to have uh, that that flexibility of mind. All right. By the way, if you were watching yesterday, my phone works fine. I went to the Apple store. I literally walked in. They fixed my phone on the spot. It wasn't hard to do. But nonetheless, I'm so grateful to the people at the Apple store in the Walt Whitman store in Huntington Station, New York, for taking me right away and not making me wait 3 or 4 hours for an appointment. So that was really cool. And I was able to get back to my office yesterday and do the live stream. I'm in my office right now if you want to know where I broadcast from. My office, and my office looks like a studio, but once I'm done with the show, the microphone goes out like this. Everything, the lights are off, my office lights are on, and I'm back to my regular workstation with my keyboard and whatever. Okay. Recession. That's what we're going to talk about today. Are we in one or are we not in one? Is recession a state of mind? Maybe we need to look at it that way. I'm going to roll the intro real quick, and we're going to have a really good show. Hey, if you have any questions, you know what to do. Ask me in the comments. Type the question in, hit it, and I will see it. I love hearing from you. It's the best part of doing this. And while you're watching, please give us a thumbs up, a heart, an applause, whatever reaction is available to you, depending on which social media platform you're watching on. And if you're watching this in the replay, welcome to you as well. Certainly go ahead and ask me your questions, and and give me your thumbs up and all that. And I definitely look forward to seeing that. Now we're going to roll the intro. Here we go. Thank you for joining me. We're just getting started. So we have a powerful stock market rally, which we've been talking about, for the last couple of weeks. And inflation's peaked already, which is something we've talked about. We went over base metals, food prices. These are all down. I mean, there are so many commodities that are literally down this year, not up. And those prices, those down prices, will eventually be worked through the manufacturing system, the process, the supply chain, and you'll start to see prices come down. In fact, you could see prices come down very, very soon. But they are going to come down. The other thing is the Federal Reserve has raised interest rates, made credit more expensive. Mortgage rates, in particular, went up a lot this year, and it's dampening consumer demand. Dampening demand. That's what the Fed wanted to do. So the Fed is trying to keep inflation lower, trying to tamp it down. And they do that by making credit, making borrowing harder to come by and more expensive. And since, our society revolves around credit, around borrowing and lending, that slows the economy. Does it slow the economy enough to send the economy into a recession? And I've been saying for the entire second quarter, which ended June 30th. Okay. Did I really need to tell you that the second quarter ended June 30th? But I will. I've been saying we're already in a recession. The GDP for the second quarter came out today was negative. It's like negative 0.9%. Not much, but the first quarter GDP was down by over 1% also. You had 2 quarters of negative GDP, which is a commonly accepted definition of a recession. And since 1948, I got my notes right here. Since 1948, the economy has never seen consecutive quarterly growth declines without being in a recession. Now, there are those that all argue we're not in a recession today. And I get that. I really do. I'm not here to give you a final, this is how you have to think. You think the way you want. Some people are going to look at this as politics and say, this is the Biden administration. Some people are going to say, this is all the leftover shit from the Trump administration. And if you're doing either one of those things, let me be the one to tell you, you're making a mistake. Everything that happens macro-wise in the economy, it's just built up from the previous administration on top of the previous one, on top of the previous one, on top of the previous one. Okay. And when presidents have a good run of the economy, it's just a matter of luck when they were elected. And presidential policies affect the next president more than the current president's policies. All right. And I've proven this already. We could go over some numbers. So let's move on though. But I do like to take a look at all of the factors going on. What we have now is a shortage of semiconductors. We had a lack of inventory because consumers were buying everything that they could get their hands on, but they were doing that at the expense of cutting back on services like traveling, vacationing, because we're in a shutdown. Now we're going back to vacationing and experiences, the experiential economy. And people have cut back on buying products, which is still hard to come by in a lot of ways because semiconductor shortages and other shortages of components. Shutdowns in like 40 big cities in China. War between Russia and Ukraine. Look, we know what's going on, and all of these things impact us on a daily basis. It's hard to say exactly how much they impact. I'm not talking emotional. I'm talking how much they impact the actual economy. So these are the things you talk about. But we are in a recession, depending on your definition of a recession. Now, not every sector of the economy is doing badly. There's as the gap between those with a lot of money, the rich are getting richer, the poor are staying poor, and the middle class is becoming poor. So there's a widening wealth gap. That's not a political statement, guys. This is a fact that there is a widening wealth gap in this country. This is a fact. Okay, I know somebody's gonna say you're being political, but I'm not. I'm just not ignoring the reality. Okay. Just give me a second. So as the rich get richer, they're impervious to economic setbacks. So that part of the world is doing very well. They're still buying what they buy. They're still They're still doing what they do. But as you could see with Walmart, like LVMH, okay, luxury brand company, their sales are up like 28%. They're booming. Walmart, which caters to obviously a much lower end customer, is struggling. I mean, there's a message in the market right there. So, we have this widening wealth gap. So, not every part of the economy is in recession. It used to be when I got into the business and I was knee high to a grasshopper. It used to be if there's a recession, it affected everybody. But today, different sectors of the economy do poorly and do well at different times in different types of market cycles, an economic recovery, economic expansion, and recession. Those are like the three main market cycles. So we might not necessarily have a recession that is hurting every sector of the economy at the same time. So really, recession is overall who's hurting, who's not, where's the weakness, where's the strength. And you really, I think, have to take recession on a case by case, industry by industry basis, and not necessarily say the overall entire economy is in a recession. I mean, from the macro picture, if we had two quarters of negative GDP, yeah, recession, but not it. We've been in recessions that have felt way worse than the one we're in now. But this is pretty bad. And the reason is because inflation is just eating up money. It's making people feel poorer, spend less. And when there's times of inflation, people don't try to maintain their spending. They try to cut back on their spending, which makes the economy even worse. And you take a look at a company like Apple that said they're getting ready for an economic downturn. They're going to cut employment. They're going to, cut expenses, whatever. If enough companies do that, that's enough to tip us into a recession. So if we all got ready for a recession, whether if one was coming or not, if we thought a recession was coming and we all prepared for it, if we all prepared for a recession, we would become a self-fulfilling prophecy. We would cause the recession, because when you cut your spending, it's good for your personal finance. If we all cut our spending, that's really bad for the overall economy. All right. So I can't say for sure if we're definitely in a hardcore, typical definition of a recession with a severe economic downturn. But I can tell you, most people in America are in a recession. Not all, but most. So this is really a more, I guess, accurate way to look at defining if we're in a recession or not. I've been making the call. I've been saying we're going to get a negative quarter of GDP, and we did. I'm not the only one to make the call, but I said it. So here we are. So let's take a look at how things did today, because the market is going up on the stuff. Okay. Like I said, if we're thinking we're into a recession, and by the time we get to a recession, by the time it's announced, 2 quarters of negative GDP, stocks will have already started going up, because stocks are anticipating the end of the recession and the end of Federal Reserve monetary tightening, meaning interest rate hikes. So the Dow up over 300 following yesterday's big rally. NASDAQ up 130 points, up another 1% on top of the 4% plus day it had yesterday. S&P was up. We're having a winning week. We're having a winning month. It's been pretty good. Okay, oil was only up 4 cents, so that's good for most of us, except for oil stocks, but it's good for most of us. Gold is moving up a little bit. The 10-year yield is down to 2.67%. We were just at like 3.4 recently. Okay, and the VIX down to 22. See that number down to 22? We need to see that number. Okay, let me highlight it. We need to see that number go to below 20, and that'll give you a really good confirmation that this rally is real. But this rally is very real, and it's very powerful. Let's take a look at bonds. The 2-year at 2.86, the 10-year 2.67. Still, it's actually slightly more than 2.67. Where was it? 2.86. Still about a 20 basis point spread. So still an inverted yield curve, which tells you that inflation is on the way out, not on the way up. Okay, on the way down. But long yields basically were down almost across the entire bond spectrum. The 30 was up a couple of ticks, and the rate, the 1 month was up, 0.007. That's 7 thousandths of a basis point. Who cares? It's pretty much meaningless. And just for shits and giggles, I'm looking at Beyond Meat, which is 31. It says the range was 134 to 20. But if you look at the chart, the stock did briefly go into the 200s. And ever since then, people have been thinking you could go back to 200. But 200 down to 30 is like a $20 stock. So it's down to 31. It's like a $20 stock going down to 3. Have you ever had a stock go from 20 to 3 that actually recovered? No, I didn't think so. And that's what this is like. So people are hanging on to this. Like one day, this is just going to make it all the way back up, and everybody's going to eat plant-based burgers from Beyond Burger. No, this is the perils of getting into a one-trick pony, and the perils of individual stock investing, which I'm not against, by the way. Just you should know. Okay. The NBER. Okay. Let me just scroll for a second. All right. The National Bureau of Economic Research is the organization that calls recessions in this country. I've talked about this before in the show. Most people don't realize it. People think the Federal Reserve calls recessions, or the Treasury Department calls a recession, whether if it started or didn't start or when it started. No, but it's the NBER. That's like the official group. And some recessions are not necessarily 2 quarters of negative GDP. For example, we had the pandemic. We went into like a 6-week recession when the pandemic started and came out of it, according to the NBER. So it's not necessarily 2 quarters of GDP. In fact, the NBER doesn't even say anywhere that they go by 2 quarters of negative GDP. 2 quarters of negative GDP certainly means that the economy is weak or weakening, but it doesn't necessarily to them mean we're in a recession. But the organization is generally thought of to use 6 factors: personal income minus transfer payments, non-farm payrolls, employment is gauged by the Bureau of Labor Statistics household survey, real personal consumption expenditures, sales adjusted for price fluctuations, and industrial production. That's what they go by. Nobody said anything about 2 quarters of negative GDP. I'm not even sure who came up with that 2 quarters of negative GDP. I mean, it sounds good. It sounds logical. So based on your perception, though, we might not be in a recession based on, your perception. And I think that's what it comes down to. All right. So let's take a look at something else. The House passes the bill to boost the U.S. chip production and China competition, sending it to Biden. It's very good news, folks. We need the semiconductor bill. We need the initiative to take the initiative to become the powerhouse of semiconductor manufacturing that we were. The brains of everything we buy is a semiconductor. And we get our semiconductors from overseas, especially from Taiwan, who literally could be invaded by China. And if that happens, we're really in bad shape. So we've got to invest in our own production, onshore things, and rely less on foreign partners. That'll make prices go up overall eventually, but it's good for financial, economic stability. All right, so that's really good. In other news, Apple came out with numbers after the close. They were pretty good. We'll read more about it later, but good handset business, good cash money. They have a lot of cash. So stock's up 2% aftermarket, almost 3% aftermarket trading. So that's pretty good. Amazon is up nicely, up almost $15, up 12%. That's a big day. Up 12% is a huge day. I mean, 12% is a good year in the stock market, let alone one day for a stock. So it's up 12% in aftermarket trading, and the stock is still way below its all-time high. So if you're thinking you missed it, there's a few other things to consider. I don't like this. Oh, I missed it already. Okay, so let's just get that straight. If I say you didn't miss it, then I'm giving a buy recommendation, right? And I don't want to be doing that on the live stream. All right. What else do we have? Baby, that's pretty much it. That's it. So Thursdays I usually do a shorter of a show. Plus, it's kind of nice, and I don't know how many people are really watching. So, I'm gonna end it here. It's a good winning week for Wall Street, a good winning month for Wall Street. The rally we're in now appears to be very powerful for the reasons we've been talking about. Rates are starting to go lower, long-term rates going lower. Good for the tech companies, but the mega cap tech companies like Amazon and Apple are going up. And when those go up, they lift the whole market with them. So it's really hard to argue. It's really hard to be bearish now. I posted about this today on my social channels. So if you wouldn't mind, take a look at my social media. Maybe follow me on whatever platform you're on. Subscribe or give it a thumbs up, and it helps me get the good word out there. I'm going to let you go now. Unless anything really crazy happens tomorrow, I don't do the live streams on Fridays, and I'll be back on Monday. Have a great weekend, everybody. Thank you so much.